What if I told you that when you buy a stock, you're not actually investing in that company? What if the diversified portfolio your financial advisor sold you was actually concentrating power into the hands of 3 firms that now control the entire economy? Here's the uncomfortable truth. Modern investing isn't about choice. It's about the illusion of choice. You open your brokerage app. You see thousands of stocks, hundreds of ETFs, dozens of index funds. It feels like freedom, like you're making independent financial decisions. But here's what they don't tell you. No matter what you buy, Apple or Microsoft, Coca-Cola or Pepsi, Exxon or Chevron, you're funneling your money to the same 3 companies: BlackRock, Vanguard, State Street. These 3 firms are the largest shareholders in 96% of S&P 500 companies. They're the biggest owners of your bank, your grocery store, your pharmaceutical company, your airline, your media outlet. They control $22 trillion in assets. That's more than the GDP of the United States. And you handed it to them one index fund purchase at a time, thinking you were building wealth. But what if you were actually building their empire? Before we go deeper, drop a comment. Where are you watching from? And do you know who actually owns the stocks in your portfolio? Because this story will show you that your retirement account is financing the greatest consolidation of corporate power in human history. Subscribe for the unfiltered truth about who really controls your money. Let's go back to 1975, the year they invented the trap. In 1975, John Bogle founded Vanguard and created the first retail index fund, the Vanguard 500 Index Fund. The pitch was revolutionary. Instead of paying high fees to active fund managers who try to beat the market, just buy the entire market at low cost. Own a piece of every major company. Get average returns. Pay minimal fees. It sounded democratic, egalitarian, a way for ordinary people to access Wall Street without getting ripped off by brokers and fund managers charging 2% annual fees. And it worked. Sort of. Index funds exploded. By 2024, over $14 trillion is invested in index funds and ETFs globally. Passive investing went from a fringe idea to the dominant investment strategy for retirement accounts, pensions, and institutional money. But something happened that Bogle didn't anticipate, or maybe he did, and nobody cared. When you buy an index fund, you're not buying stocks. You're buying shares in a fund that owns stocks. And that fund is managed by a company. BlackRock, Vanguard, State Street. Those companies hold the actual shares. They vote on shareholder resolutions. They influence board decisions. They decide executive compensation. They shape corporate strategy. You, the individual investor, own nothing but a claim on the fund's performance. Sound familiar? Because this is the exact same structure as a bank. You deposit money. The bank owns it. You get a claim on it. But the bank decides what to do with it, who gets loans, what gets financed, what gets built. You think it's your money, but it's not. It's the bank's money. You're just a creditor. Index funds work the same way. You think you own Apple stock, but you don't. BlackRock owns Apple stock. You own shares in BlackRock's fund, and BlackRock gets to vote. Here's the kicker. BlackRock, Vanguard, and State Street are now the largest shareholders in almost every major corporation. Let me give you examples. Apple, Vanguard 8.2%, BlackRock 6.8%, State Street 4.2%, equals 19.2% combined. Microsoft, Vanguard 8.8%, BlackRock 7.4%, State Street 4.0%, equals 20.2% combined. Amazon, Vanguard 7.1%, BlackRock 6.2%, State Street 4.1%, equals 17.4% combined. ExxonMobil, Vanguard 8.9%, BlackRock 7.2%, State Street 5.1%, equals 21.2% combined. JPMorgan Chase, Vanguard 8.3%, BlackRock 6.9%, State Street 4.6%, equals 19.8% combined. They're the biggest owners of everything. Sound familiar? Because this is what monopoly looks like in the 21st century. Not one company owning everything, but one ownership structure owning every company. Standard Oil got broken up in 1911 for having too much power in one industry. But BlackRock, Vanguard, and State Street own the top companies in every industry, and it's perfectly legal. Why? Because they're passive investors. They claim they're just tracking indexes, not actively controlling companies. But that's a lie. When you own 20% of a company and you vote on every shareholder resolution, every board election, every merger, you're not passive. You're the de facto controlling interest. And here's where it gets darker. These 3 firms don't just own competitors in the same industry. They own both sides of every competitive market. They own Coca-Cola and Pepsi. They own Delta and United and American Airlines. They own JP Morgan and Bank of America and Citigroup. They own Exxon and Chevron and BP. and they own Pfizer and Johnson & Johnson and Merck. Sound familiar? Because this is what cartel formation looks like. When the same entities own all competitors, there's no incentive to compete. There's every incentive to cooperate, raise prices, suppress wages, and maximize shared profits. This is called common ownership theory, and it has been studied by economists and antitrust scholars for a decade. The research is damning. A 2015 study found that common ownership by institutional investors led to higher airline ticket prices costing consumers $4 to $6 billion annually. A 2017 study found that banks with common ownership charge higher fees and pay lower interest on deposits. A 2018 study found that pharma companies with common ownership spend less on R&D and charge higher drug prices. Competition dies when the same shareholders own everyone, and the biggest shareholders: BlackRock, Vanguard, State Street. But here's the part that makes this a true conspiracy. You, the retail investor, think you benefit from this system. You're told your index fund is diversified and low cost, but you're not diversified. You're concentrated into a power structure that eliminates competition and inflates asset prices. And you don't benefit from the real power of the voting rights. BlackRock benefits. They vote your shares. They influence the companies. They collect fees. They build empires. You just get the scraps. This is the illusion of choice. And it's about to get so much worse. So how did 3 companies end up controlling everything? It wasn't an accident. It was engineered through a single innovation that changed investing forever. Exchange-traded funds, ETFs. Before ETFs, if you wanted to buy an index fund, you'd go through a traditional mutual fund company. You'd place an order, and once a day after the market closed, the fund would execute it. ETFs changed that. They trade like stocks. You can buy and sell them instantly, all day, on any exchange. It sounds like a small technical improvement, but it unleashed a tsunami. ETFs exploded from $100 billion in 2000 to over $10 trillion by 2024. And who controls the ETF market? BlackRock, Vanguard, State Street. BlackRock's iShares is the largest ETF provider in the world, over $3 trillion in assets. Vanguard is second, $2.6 trillion. State Street's SPDR funds are third, $1.3 trillion. Combined, these 3 firms control over 70% of the global ETF market. They built the products. They market the products. They profit from the products. And every time you buy an ETF, whether it's SPY, VU, QQQ, or any of the thousands of others, you're giving them more control. But here's the twist nobody talks about: who owns Vanguard? BlackRock is publicly traded. You can see who owns it. Spoiler alert: Vanguard is the largest shareholder of BlackRock. State Street is publicly traded. You can see who owns it. Spoiler alert: Vanguard is the largest shareholder of State Street. But Vanguard? Vanguard is privately held. It's owned by its funds, which are owned by investors, which means it's a circular ownership structure that makes it nearly impossible to see who actually controls it. It's a black box. And this black box is the largest shareholder of almost every major company in the world, including BlackRock and State Street, its supposed competitors. Think about that. Vanguard owns BlackRock. BlackRock owns Vanguard funds. Vanguard owns everything. BlackRock owns everything. It's not competition. It's a network. An interlocking ownership structure that concentrates power while maintaining the appearance of separate firms. And the guy who built it? The guy who saw this coming and designed the system. You won't believe the name. And the receipt is wilder than you think. Let's break down exactly how this consolidation happened and why your choice is an illusion. Mechanism 1. Index fund structure and voting power concentration. When you buy shares in an index fund, here's what actually happens. You give money to BlackRock or Vanguard or State Street. They pool your money with millions of other investors. They buy shares in hundreds or thousands of companies. You receive shares in the fund, not the companies. And BlackRock retains the voting rights for the actual shares. This is critical. You don't vote. BlackRock votes. And BlackRock votes on everything: board elections, executive compensation, mergers and acquisitions, environmental policies, social governance issues, and shareholder proposals. In theory, BlackRock is supposed to vote in your interest. In practice, they vote in their interest. Let's look at the numbers. As of 2024, BlackRock holds voting rights for shares worth approximately $10 trillion. Vanguard, $8.5 trillion. State Street, $4.2 trillion. Combined, $22.7 trillion in voting power. That's more economic power than any government on earth outside the US and China. And it's concentrated in the hands of a few dozen executives at 3 firms. This isn't capitalism. This is financial feudalism. Mechanism 2. Common ownership and the death of competition. Here's where it gets sinister. When the same institutional investors own large stakes in competing companies, those companies stop competing. Why? Because the shareholders benefit more from coordination than competition. Let me give you a concrete example. Airlines. Before the rise of index funds, airlines competed aggressively on price. Ticket prices fell throughout the 1990s and early 2000s as deregulation allowed new entrants and price wars. But by 2010, something changed. BlackRock, Vanguard, and State Street had become the largest shareholders in Delta, United, American, and Southwest. What happened next? Airfares rose 30% from 2010 to 2019, far outpacing inflation. Fees exploded: baggage fees, seat selection fees, change fees. Service quality collapsed: smaller seats, fewer flights, more delays. And profit margins hit record highs. A 2017 study published in the American Economic Review found that common ownership by institutional investors directly caused this price increase, costing consumers $4 to $6 billion annually. Why would airlines compete on price when the same shareholders own all of them? If Delta cuts prices, it hurts United's profits, but it also hurts Delta shareholders, who also own United. The shareholders, BlackRock, Vanguard, State Street, prefer industry-wide high prices over competitive low prices. This is cartel behavior, legalized through passive investing. The same pattern appears in banking. Common ownership linked to higher fees and lower deposit rates. Pharmaceuticals. Common ownership linked to higher drug prices and reduced R&D. Tech. Common ownership linked to reduced innovation and anti-competitive mergers. Energy. Common ownership linked to coordinated production limits and price stability. Everywhere you look, the same structure. Consolidated ownership, reduced competition, higher prices. Mechanism 3. The ETF fee trap and parasitic extraction. Now, let's talk about fees, because this is where the real extraction happens. Index funds are marketed as low cost, and compared to actively managed funds charging 1 to 2%, they are. But low cost doesn't mean no cost. The average expense ratio for an index fund is 0.03% to 0.20%. Sounds tiny, right? But let's do the math. $10 trillion in BlackRock's index funds and ETFs, charging an average of 0.10% annually. That's $10 billion per year in fee revenue for BlackRock. Every year, forever, for doing essentially nothing. Because index funds are passive, they don't pick stocks, don't time markets, don't do research. They just track indexes. But BlackRock collects $10 billion annually for this service. Vanguard, $7 to $8 billion annually. State Street, $3 to $4 billion annually. Combined, $20 to $22 billion per year in pure extraction. And it compounds. If you invest $100,000 in an index fund with a 0.10% expense ratio for 40 years, assuming 7% annual returns, you'll pay approximately $30,000 in fees over your lifetime. That's not invisible. That's 30% of your gains going to asset managers for algorithmic index tracking. But here's the even darker part. BlackRock doesn't just collect fees from retail investors. They collect fees from institutions, pensions, endowments, sovereign wealth funds. And they use that capital to build power. Mechanism 4. BlackRock's Aladdin and the systemic risk engine. Here's something most people don't know. BlackRock doesn't just manage $10 trillion of its own. It also operates the risk management software for much of the financial industry. It's called Aladdin Asset, Liability, Debt, and Derivative Investment Network. Aladdin is the operating system for modern finance. It processes over $21 trillion in assets, double what BlackRock directly manages. Banks, hedge funds, pension funds, insurance companies, sovereign wealth funds, they all use Aladdin to assess risk, price assets, execute trades, manage portfolios, and model scenarios. BlackRock built it. BlackRock operates it. BlackRock sees everything. Think about the power that creates. BlackRock knows what every major institution is buying and selling. BlackRock knows what risks they're taking. BlackRock knows what assets are mispriced. And BlackRock has real-time data on the entire financial system. This is information asymmetry at an unimaginable scale. And it gets worse. During the 2008 financial crisis, the Federal Reserve hired BlackRock to manage the bailout programs valuing toxic assets, advising on which companies to save. During the 2020 COVID crisis, the Federal Reserve again hired BlackRock to manage corporate bond purchases and asset-backed securities programs. BlackRock essentially became the Federal Reserve's operating arm, a private company, managing public bailouts, with access to government money, making decisions about which companies survive. This is regulatory capture on steroids. Mechanism 5. The illusion of choice in index selection. Let's go back to your investment choices. You open your brokerage app. You see S&P 500 Index Fund, Total Stock Market Index Fund, Nasdaq 100 Index Fund, International Index Fund, ESG Index Fund. Small Cap Index Fund. Looks like choice, right? Wrong. All of these indexes are controlled by a few index providers. S&P Dow Jones Indices, owned by S&P Global. MSCI, FTSE Russell, owned by London Stock Exchange Group and Bloomberg. These companies decide which stocks go into which indexes. They set the criteria. They rebalance the indexes. They determine the weightings. And who are the largest shareholders of these index providers? You guessed it. BlackRock, Vanguard, and State Street. So the same firms that manage your index funds also own the companies that create the indexes. They control both the product and the definition of the product. This is vertical integration on a scale that would make Standard Oil blush. Mechanism 6. The proxy voting scandal and stealth governance. Here's the final piece of the puzzle. BlackRock, Vanguard, and State Street vote your shares. But how do they vote? In theory, they're supposed to vote in the best interest of their fund investors, meaning you. In practice, they vote however they want. And the evidence suggests they vote to support management. BlackRock votes with management 95% of the time. Why rock the boat when you own everyone? Advance ESG agendas. BlackRock has pushed environmental and social governance policies across thousands of companies, not because investors demanded it, but because BlackRock CEO Larry Fink decided it was good branding. Block activist investors. When hedge funds or activist investors propose changes to increase shareholder value, BlackRock often votes against them, preserving the status quo. This is taxation without representation. Your money, their votes, their agenda. You have zero say. And when you own 20% of every company, you don't need to control 51%. You just need to be the largest shareholder and vote strategically. That's enough to control board elections, CEO compensation, and corporate strategy. Mechanism 7. The network effect and the impossibility of exit. Here's the final trap. Even if you wanted to avoid BlackRock, Vanguard, and State Street, you can't, because they own everything. If you buy individual stocks, they're the largest shareholders. If you buy mutual funds, most are managed by them or hold similar positions. If you buy bonds, they're the largest bondholders. If you invest in real estate, they own the REITs. If you invest internationally, they dominate foreign markets too. There is no escape. The system has been built so that all capital, regardless of how you deploy it, flows through this oligopoly. And once they have your money, they have the votes. They have the power. You're a passive participant in your own financial subjugation. So where does this leave us? The illusion of choice in modern investing isn't a bug. It's the core feature. You were told that index funds democratized investing, that they gave ordinary people access to the market at low cost. But what they actually did was consolidate power into the hands of 3 firms that now control corporate America, vote on every major decision, and eliminate competition across every industry. And it's accelerating. Passive investing now represents over 50% of all U.S. equity assets. Within 10 years, it could be 70 to 80%. When that happens, BlackRock, Vanguard, and State Street won't just influence the economy, they'll be the economy. Every company will answer to them. Every board will defer to them. Every policy will reflect their priorities. This is neo-feudalism dressed up as financial innovation. You don't own assets. You own claims on a system that owns everything. You don't make investment choices. You pick from a menu designed by the same 3 firms. You don't have voting power. You've outsourced it to an oligopoly. Here's the brutal truth. Modern capitalism isn't competitive. It's captured. And your index fund is the mechanism of capture. The lesson here isn't to abandon investing. It's to see the system for what it is. You can't opt out completely, but you can stop pretending your index fund is independence. You can diversify into assets that don't control real estate, businesses, skills, relationships. You can vote with your dollars by supporting actual competition where it still exists. And you can stop believing the lie that passive investing is neutral. So I'll leave you with this. Are we wiser now, or are we just better educated serfs in a financial empire we built ourselves? Drop your thoughts below. Subscribe if this exposed the truth. Share this with anyone who still thinks their ETF is freedom. The illusion dies when we name it.